Welcome to It's the Economy. The inflation data we got yesterday was a little higher than estimates, and the industrial growth data was a little lower than estimates. Nothing dire, but this is not a happy combination. What was more painful was inflation was pushed up by food inflation running at 8.6%, with the two most important ingredients, cereals and veggies, rising in double digits. On the industrial growth front, the most painful number was consumption. Consumer non-durables actually contracted by 10% this August compared to 1 August ago. To assess both growth and inflation numbers, I have with me two perhaps of the foremost economists in the country, Mridul Saggar, the IEPF chair professor at NCAER, and more importantly, former MPC member, and Samiran Chakraborty, the chief economist at Citibank India. Gentlemen, thank you very much indeed for joining me. Mridul, let me start with you. The CPI is only 10 basis higher than what the street was expecting. But like I pointed out, food at 8.6, core still running at 6.1. Is the Reserve Bank's trajectory of 5.8% by March under danger? Do you think it won't get there?
As of now, no, Lata. I think RBI projections are pretty realistic. So, in fact, this quarter average is 7 vis-a-vis 7.1 estimated by the Reserve Bank. So I don't think the numbers are at threat. But irrespective of the numbers, I think what is important is the momentum is staying. And the momentum in October at 0.57 month-on-month increase in CPI index is above the average for the September we normally see. If you see the pre-pandemic, it's like more like 0.34.
Oh.
So the momentum is high. Inflation expectations as per the RBI's latest survey are climbing. So you can't really relax the vigil on inflation in these circumstances, and you need monetary policy to control the second round effects. Any sort of impact on inflation expectations might come in more generalization. The generalization numbers which I'm seeing, it climbed up quite a lot in April, but then a little bit has receded, is higher across commodities, and is staying put between October and September. No material difference in that.
Okay.
So this is how I'll react.
Okay. Samiran, a somewhat similar question to you. As Mridul pointed out, even that worried me. The month-on-month inflation running at 0.6% in September over August. Now, October, again, the delayed withdrawal of monsoon, late rains. Do you think we are in for persistently upside surprises or shocks in inflation? Are you changing your numbers in the first place?
So, Lata, just to take forward the point that Mridul was mentioning, I'm more worried that the persistence is there on the core inflation side rather than the headline. The core inflation month-on-month changes are practically getting cemented around 0.5%, which is annualized 6% for CPI, and doesn't look like that the effect of monetary policy is being felt at all, even on the core inflation number. But I guess the upside risk is going to come from these unseasonal rains and something which is brewing, which is the high increase in fodder prices. And it can fit into the component of inflation on meat, eggs, etc., which was relatively benign till now. This high fodder prices can feed in there. And the last risk that we have highlighted is that the services inflation, particularly contact-based services, was receding in the last few months. And suddenly in September, we have seen again an uptick in that number. It could be because of festive season demand, but if it is more sustained, then this will be another upside. So altogether, we have put a view of about a 30 basis point upside risk to our current projection of 6.7% for the full year, which is similar to RBI's projection. But that 30 basis point is mainly going to come from food, fodder, and services.
And it is not a small number. I mean, that pushes 6.7 to 7. So it can be uncomfortably high. I'll come back to inflation, time permitting. I'm actually worried about the growth number as well. We don't lay great store by IIP, I would assume. But the contraction, 0.8, consumer non-durables contraction by 10%, seen along with the PMI number for September also, which clearly receded. How would you look at growth, Samiran?
So, Lata, actually, you were right that normally we don't talk about IIP as much as we do CPI. But this time, this has caught even my attention. If you look at it, this is the fourth consecutive month of month-over-month decline in the IIP index, which shows that there is something which is slowing down. And what is confusing is that if you look at some of the other high-frequency growth indicators, they are not showing that kind of sluggishness. At max, we can say that our high frequency combined indicator is getting flatlined rather than falling, whereas IIP is showing signs of
Even
falling.
core did.
And
Even core did, right?
exactly. And what was also interesting was that the consumer non-durables fell much faster than consumer durables, which is in line with our general understanding that rural demand is more sluggish compared to the urban demand. That's where it shows up. And even the investment side, the capital goods component is started falling, whereas our investment indicator from other high frequency growth data seems to be more flattish rather than falling. So IIP is signaling something which is slightly different from what other indicators are showing, but it could be a harbinger of saying what we analysts are factoring in, that in the second half of the year, growth would be relatively slower compared to the first half.
Okay, Mridul, I would want your view on that. You know, another number which we didn't report enough, but Soumya has said it in his report, Soumya from SBI, capital capacity utilization. In Q4, the governor even read out the number, said 75.3. The latest Obicus survey is saying 72.4. Overall, same question. Is growth getting tired?
Now, as far as capacity utilization is concerned, once you seasonally adjust the numbers, they are above the trend. So, per se, it's an ideal situation where more investment can kick in. But will that happen given the uncertainties which are unfolding globally? I think people will wait and watch before putting in money on the investment table. So, that could probably what Philip, the growth could have got from investment side. We still have to wait and watch how that can come through. But there's absolutely no doubt that the growth is slowing down, and there is reason for it to slow down. I mean, we are seeing synchronous monetary policy tightening across the globe. Financial conditions are tightening, and they have sizably tightened, and emerging markets are facing the brunt now. So growth has to slow down. I mean, I would expect it next year to be closer to 6, slightly above maybe, but there are downside risks also. So this is the environment we have to live with, and we have to complete the task of soft landing from the monetary policy side, bring inflation under reasonable control. That's the only way the macro will work.
Oh, you know, FY24 growth, RBI only gave us Q1 and I think they put it at 7.2 or something. Samiran, FY24, Nomura has a 5 handle, I think 5.2 if I'm not mistaken. Your number, and have you lately brought it down?
So, Lata, we are for FY24, we have it close to 6, just a tad lower than that at 5.9. But the challenge really is that the global growth outlook itself is extremely uncertain now. We are talking in terms of more scenarios rather than having just one forecast for the global outlook. Or global economists have put out even a hard landing scenario possibility where global growth could fall to 0% as well. Under those circumstances, we might have more downside risk to the India growth forecast as well. Because this time around, even if the global economy slows down, the kind of support that you have normally seen global central bankers doing QE, and that helping capital flows into India and India's asset markets, etc., that channel might not be very dominant this time around, which leaves us with the negative effect from the export side affecting our growth in FY24.
Is that the only impact, Samiran? I mean, of course, exports have already started showing that impact. But, I had an interview with Raghuram Rajan yesterday. The UK gilt issue, pension funds over-leveraged and therefore unraveling when interest rates go up very fast. There seems to be a financial instability issue, not just in EMs, but developed markets like UK, even Germany. There were some pension funds which have this leverage issue. Just your thought on this whole financial instability problem in DMs and whether there can be ripple effects of any kind on the real economy in India.
Lata, we are living in uncertain times, to say the least. Sorry, is there a question for Mridul?
Yes. No, it's for you, Samiran. Go ahead. I will go to Mridul.
Okay. Sorry. What I was saying was that, look, global interest rates are up somewhere around 400, 500 basis points, depending upon what you're looking at. Dollar is up 20% plus. Fed is talking about tapering its balance sheet by trillions of dollars. Under these circumstances, shocks to the financial market is a real risk that we have to acknowledge. But as economists, our problem is that we cannot make growth forecasts based on expected shocks. That's quite difficult. So if something happens to any UK market or any other global market, we have to respond to those events in our growth forecast at the best, but it's difficult a priori to start factoring them into growth numbers. What we can factor in is only the global growth slowdown and its consequent effect on the Indian economy. Apart from the export channel, I think the other channel which Mridul was mentioning is that investment uncertainty leads to capex slowdown. So that process can get further extended if the global slowdown continues.
Okay. Mridul, I'm running out of time and I'm going to ask you some unfair set of questions. One, your comment on this financial instability in a word. How will RBI look at it in terms of external sector, etc.? And secondly, now MPC has to write that letter to Parliament explaining why they failed. Is that a pressure on the MPC? And will that make them borderline more hawkish?
So I don't think they will borderline would cause them to turn hawkish. I think they can explain the sort of breach which has occurred. In today's world, practically every inflation targeting central bank is facing that. So as I said last time, I think what is very important is we should not attach a stigma to that breach.
Okay.
What is most important is how credibly the central bank explains the reasons for the failure, the time period it will take to come back to the target, and the steps it will take in order to lower the inflation towards the target. I think that path would be very critical. I'm not sure it would be in public domain. As per the rules, they have to write a letter to the government, and then one has to see how the process takes place from there. Okay. So one has to wait and see on that aspect. But yes, on the financial instability, I think what Samiran was saying is absolutely the crux of the matter, and what you have been pointing out in your discussions with the Professor Raghuram Rajan yesterday, that also revealed a lot. So clearly, as I said, it's a tip of the iceberg, what we are seeing now. And though the good part is that the global financial regulatory reforms post-global financial crisis have made banking sector resolute, relatively resolute at least. And what we need to see is how the shadow banking sector, now no longer the term is used, the non-banking financial intermediaries respond to this liquidity tightening, and whether there are network effects which will become very prominent. And I believe there are a lot of strong network effects which are there as the hidden leverage which people have been pointing it out.
Yeah.
So RBI, to my mind, needs to remain focused on macro financial stability. I think we should stop debating too much on the inflation and growth numbers.
Okay.
This is not the right time to worry about those things. Growth will come automatically once macro stability is ensured.
Absolutely.
But growth can get derailed if macro financial stability suffers. And there could be trigger points in near terms also.
Yeah, I take your point entirely, Samiran and Mridul. Thank you very much for an extremely enlightening discussion. They are more worried about inflation and more worried about growth, but really now you can't take the eye off the financial stability ball, especially with UK pension funds once again being reported to be selling bonds because of the fall in prices. I mean, it's financial stability that is going to be core for decision makers. Wrap up on Bazaar. Trading ideas coming up for you on Chartbuster.